On a cold morning in January 2021, a hedge fund manager in Manhattan stared at his screen and watched his fortune evaporate in real time. $3 billion, then 4, then nearly 7 billion gone in a matter of days. He had bet against a dying video game retailer called GameStop. Convinced that the company was finished, and on paper, he was right. The stores were empty. The business model was broken. The stock should have collapsed. But something had gone terribly wrong, because while he was sleeping, an army of ordinary investors on the internet had discovered his bet, and they were about to execute one of the most spectacular financial ambushes in modern history. This is a story that most people saw as a battle between small traders and Wall Street giants. But underneath that story lies a far darker reality, a hidden industry that has been quietly operating for decades. An industry that generates billions of dollars by betting that companies will fail, that jobs will disappear, and that entire businesses will collapse. Hedge funds do not just trade on rising markets. They have engineered an entire ecosystem of profit from destruction, where the worse a company performs, the richer certain people become. And most ordinary investors have no idea how deep this machine goes, or how much power it holds over the companies they work for, the stocks in their retirement accounts, and the prices of things they buy every single day. Today, we are going to pull back the curtain on the business of betting against companies, the technique known as short selling, and the elaborate strategies hedge funds use to turn corporate failure into personal fortune. We will follow the money, we will name the players, we will examine the mechanics, and we will ask the question almost nobody asks out loud. Is this legitimate capitalism doing its job, or is it something much closer to financial predation hiding behind the language of markets? To understand how this industry works, you first need to understand what short selling actually is, because almost everything written about it in mainstream financial media is either oversimplified or deliberately vague. When you buy a stock the normal way, you hand over money, you receive shares, and you hope those shares become more valuable. Your downside is limited to what you paid, and your upside is theoretically unlimited. Short selling flips this entire relationship upside down. A hedge fund approaches a large institution, typically a pension fund, a bank, or a broker, and borrows shares of a company it believes is going to decline. These shares are not purchased, they are rented, with a fee paid to the lender for the privilege of borrowing them. The hedge fund then immediately sells those borrowed shares on the open market at the current price, collecting the cash from the sale. Now the fund is sitting on a pile of money and a debt. It owes the lender shares, not dollars, shares. And at some point in the future, the fund must return those exact shares to the lender. The plan is simple. The hedge fund waits for the stock price to fall, then buys back the shares at the lower price, returns them to the lender, and pockets the difference between the higher price at which it sold and the lower price at which it repurchased. If a fund shorts a stock at $100 and the stock falls to $20, the fund has made $80 per share in pure profit, minus the borrowing fee. Multiplied across millions of shares, this produces extraordinary sums of money. But notice what has happened here philosophically. The fund has created a financial position where its success is directly tied to another company's failure. Every dollar the company loses translates into a dollar the fund gains. The incentive structure is no longer aligned with productivity, innovation, or growth. It is aligned with collapse. And this is where the story becomes genuinely dark. Because once you have a financial incentive to see a company fail, the natural human tendency is to help it fail a little faster. In the ecosystem of hedge funds that bet against companies, there is a specific subspecies known as the activist short seller. These are not passive investors waiting patiently for their thesis to play out. They are combatants, researchers, and publishers, and their primary weapon is information, some of it devastatingly accurate and some of it devastatingly convenient. The playbook is precise. An activist short seller first identifies a target, usually a company with aggressive accounting, a charismatic but questionable chief executive, unusual cash flow patterns, or a business model that sounds better than it actually performs. The fund spends months, sometimes years, accumulating evidence. They interview former employees. They file public records requests. They analyze satellite imagery of parking lots. They count trucks leaving factories. They pay private investigators to trail executives. They hire translators to read foreign language filings. By the time they are ready to strike, they have assembled a dossier that a national intelligence agency would respect. And then, only after they have already built their short position, they publish. The report drops publicly, often as a lengthy document posted to the fund's website, timed to maximize media coverage. Financial journalists reproduce the allegations. Analysts downgrade the stock. Other hedge funds pile on. The company scrambles to respond, but the damage is already in motion. Share prices collapse, sometimes in hours. The short seller closes the position at a massive profit, and the cycle repeats with a new target. Now, to be fair, some of these reports have exposed genuine frauds. Companies that were cooking their books, lying to shareholders, or operating outright scams. The short seller in these cases plays a role similar to an investigative journalist, exposing truths that regulators missed. But the model contains an obvious problem. The short seller has a financial incentive to make the target look as bad as possible, and the rules governing what they can publish are far looser than the rules governing company disclosures. A hedge fund can publish a report containing selective evidence, dramatic accusations, and carefully chosen framing, and as long as they do not lie outright, there is little legal consequence. The company that gets hit has to spend months defending itself, even if the accusations turn out to be exaggerated or incorrect. By then, the short seller has already collected the profit and moved on to the next target. Let us walk through a specific hypothetical example, built from patterns observed across many real cases, so you can see exactly how the machine operates. Imagine a mid-sized technology company whose stock has been climbing steadily for 2 years. A hedge fund notices something unusual in the company's recent quarterly filing: a discrepancy between cash on the balance sheet and cash implied by operating activities. This could mean nothing, or it could mean the company is borrowing aggressively to finance operations while presenting itself as profitable. The fund decides to investigate. Analysts spend 6 months digging. They find that the company has been booking revenue from deals that have not yet been delivered. They find that a major customer is actually a related party owned by the chief executive's brother-in-law. They find that a factory in Vietnam, which the company claims produces half of its inventory, appears almost empty when viewed by satellite. Armed with this evidence, the fund quietly begins building its short position, borrowing shares and selling them into the market over the course of several weeks, careful not to move the price and alert the company. When the position is fully built, the fund prepares its report. The document is professionally designed, lavishly illustrated, and written in the voice of a concerned citizen, exposing corporate wrongdoing. On the morning of release, the report is emailed to every financial journalist on Wall Street, posted to social media, and uploaded to the fund's website. Within hours, the stock is down 15%. Within a day, it is down 30%. The company issues a statement calling the report inaccurate and misleading. But the burden of proof has shifted. Regulators open an inquiry. Lawyers begin circling. Class action suits are filed by law firms that specialize in exactly these situations. Some of these law firms, it turns out, have informal relationships with the same hedge funds that publish the reports. The whole ecosystem moves together, efficiently, professionally, predatorily. Weeks later, when the dust settles, the stock has lost 60% of its value. The hedge fund closes its position at enormous profit. The chief executive resigns. Thousands of employees lose their jobs. The company may or may not survive, and the next target has already been identified. Before we continue, if this is the kind of story you want more of, the kind that follows the money past the headlines and shows you how financial systems actually work, behind the language they use to describe themselves, take a moment right now to subscribe to the channel and turn on notifications. Every investigation we publish takes weeks of research, and your subscription is the signal that tells us to keep going. If you have been finding value in this, return the favor. Subscribe, hit the bell, and let us continue. There is a darker layer to this industry that regulators have tried to stamp out for decades and never quite succeeded. It is called naked short selling, and it represents one of the most controversial practices in modern finance. In legitimate short selling, the fund must actually borrow the shares before selling them. There is a chain of custody, a locate requirement, and a record of the transaction. The shares being sold are real shares that someone actually owns, temporarily rented out. Naked short selling skips that step entirely. The hedge fund sells shares it has not borrowed, and in some cases does not intend to borrow. They are effectively selling shares that do not exist, creating synthetic supply out of thin air. For a brief window, the market behaves as if there are more shares of the company in circulation than the company has actually issued. This artificial flood of supply can drive the price down, sometimes dramatically, because basic economics tells us that when supply exceeds demand, prices fall. The defense of this practice is that it adds liquidity to the market and that rules require the seller to eventually deliver real shares or close the position. The reality is messier. There are regulatory gaps, exemptions for market makers, and failure to deliver situations that can persist for weeks or even months. Some companies have discovered that the number of shares being shorted against them exceeded the total number of shares the company had ever issued, a mathematical impossibility that could only occur if phantom shares were circulating in the system. The consequences for targeted companies can be existential. When a stock is hit with a coordinated naked short attack, the price can collapse so rapidly that the company cannot raise capital, cannot borrow from banks, and cannot reassure shareholders. Customers get nervous, partners pull back. A downward spiral begins that is almost impossible to escape, regardless of whether the underlying business is actually healthy. Regulators have fined firms for violations, but the fines are typically tiny compared to the profits generated. For a fund making hundreds of millions from a successful short attack, a $5 million fine is simply a cost of doing business, no different from paying rent on the office space. No discussion of hedge fund short selling is complete without examining the role of financial media, because the relationship between these two industries is far more intimate than most viewers realize. A short position only becomes profitable if enough other investors agree with the thesis and sell their shares, pushing the price down. For that to happen, the thesis needs to reach the public. And the mechanism for reaching the public is the financial press. Hedge funds understand this perfectly. Many of the largest short-selling funds maintain close relationships with journalists at major business publications. They tip reporters to stories. They provide exclusive access to research. They schedule interviews with the fund manager on financial television networks at carefully chosen moments. In exchange, the fund gets distribution, credibility, and momentum. The journalist gets a story, an exclusive, and a relationship that produces more stories in the future. The arrangement is not technically illegal. Financial television networks regularly host hedge fund managers who are openly short the stocks they are about to criticize on air. The disclosure is usually buried in a graphic at the bottom of the screen or mentioned briefly at the start of the segment. Viewers rarely appreciate what they are watching. They see an expert analyst offering a sophisticated view of a company. What they are actually watching is a paid combatant arguing against a position he holds, using the platform of a major news network to move a market in the direction of his profit. The company being discussed often has no opportunity to respond in the same broadcast, and even if they issue a statement later, the damage has already been done. The stock has moved. Retail investors have panicked. The short seller has profited. The network gets the ratings. The journalist gets the scoop. Everyone wins except the company and the shareholders who sold in fear. Some of the most respected financial publications have been implicated in this dynamic over the years, though it is rarely discussed openly. The incentive to maintain access to hedge fund sources means journalists are reluctant to expose the game even when they see it happening. And the hedge funds know this, which is why they continue to operate the playbook year after year. The difference between aggressive short selling and outright market manipulation is not always obvious, and the legal boundary has shifted over the decades. There is a specific term used in financial regulation called short and distort, which describes the practice of taking a short position and then spreading false or misleading information to drive the stock down. This is explicitly illegal, and regulators have prosecuted cases against individuals and small firms. But the large institutional players have become skilled at operating right at the edge of the legal line, using techniques that are difficult to prove as manipulation even when the effect is identical. One common technique involves publishing reports that contain a mix of accurate information, misleading framing, and speculative claims phrased as questions. For example, a report might ask whether a company's factory is really producing at the capacity it claims, without asserting that it is not. The question alone, published with dramatic supporting imagery, is enough to seed doubt in the market. Another technique involves coordinating with other funds. While explicit coordination on trades is illegal under antitrust law, informal signaling through industry conferences, shared analyst networks, and selective tip sharing creates what looks like coincidental timing. Several funds just happen to short the same stock at the same time, and just happen to publish related research in the same week. Regulators rarely have the evidence to prosecute because the coordination is conducted through conversations that leave no paper trail. There have been cases where short sellers have been caught in more egregious conduct. Fake press releases distributed through minor wire services. Anonymous negative reviews posted on investor forums. Social media bot networks amplifying negative sentiment. Even, in a few documented cases, hedge fund researchers paying sources in foreign countries to provide false testimony about a target company's operations. The problem for regulators is that proving intent is extraordinarily difficult. A hedge fund can always claim that its research was conducted in good faith, that it believed the information to be accurate, and that any errors were unintentional. And even when regulators do prove misconduct, the penalties are often modest. A fund that made $200 million on a short attack might pay a $15 million fine, retain the bulk of the profit, and continue operating. The incentive structure rewards aggression and punishes restraint. The history of short selling contains cases that have shaped markets in ways most people never learned about. Consider the pattern of attacks on Chinese companies listed on American exchanges in the early years of the last decade. Dozens of Chinese firms that had gone public through reverse mergers were targeted by short sellers who alleged that the companies were fabricating revenue, overstating factory capacity, and misleading American investors. Many of these accusations turned out to be accurate, and the exposures revealed one of the largest corporate fraud ecosystems in modern history. Short sellers who had bet against these companies made fortunes, and in this case, the system worked roughly as defenders of short selling argue it should. The frauds were exposed. The market self-corrected. Investors were saved from further losses. But for every case where short sellers exposed genuine fraud, there were other cases where the allegations were questionable and the damage was severe. Companies in biotech, clean energy, and emerging technology sectors have been repeatedly targeted by activist short reports that later proved partially or largely incorrect. Some of these companies survived, others did not. Thousands of employees lost their jobs. Billions of dollars in shareholder value evaporated. And in some cases, the short sellers walked away with profits that exceeded the entire annual revenue of the companies they had attacked. Then there are the truly spectacular failures of short selling itself, where the targeted company did not collapse as predicted, and the hedge fund was forced to buy back shares at dramatically higher prices to close its position. These situations, known as short squeezes, can destroy a hedge fund in a matter of days. The GameStop episode in 2021 was the most famous recent example. But similar events have occurred throughout financial history. Volkswagen briefly became the most valuable company in the world in 2008, when a short squeeze forced hedge funds to scramble for shares that were not available. The stock price soared to absurd levels before collapsing, and several funds never recovered from the losses. What these cases show is that short selling is not a one-way bet. The funds that practice it are taking enormous risks, and when those risks go wrong, the consequences can be catastrophic. But the industry continues to attract capital because when the bets succeed, the returns are extraordinary, and the players are skilled enough to win far more often than they lose. Zoom out from the individual cases, and a larger pattern becomes visible. The existence of a large, sophisticated, profitable, short-selling industry has effects on the economy that extend far beyond the specific companies being targeted. When a significant portion of sophisticated capital is deployed to bet on failure, the incentives of the entire financial system shift. Analysts learn that there is money in being skeptical, in finding problems, in publishing negative research. Journalists learn that short-driven stories generate more clicks than positive stories. Regulators spend enormous resources investigating accusations that may or may not be accurate. Boardrooms become defensive. Chief executives spend time managing short-seller narratives rather than running their businesses. Research and development budgets get cut because they take too long to produce results that will satisfy quarterly expectations. Long-term projects get abandoned in favor of initiatives that will boost the next earnings report. The entire time horizon of corporate decision-making shortens because the penalty for failing to meet short-term expectations has become so severe. There are economists who argue that this is actually healthy. Short sellers, in their view, serve as the market's immune system, identifying weakness and forcing companies to strengthen or die. The metaphor is appealing, but it breaks down under examination. A biological immune system is calibrated to protect the organism. It attacks threats while protecting healthy tissue. The short-selling ecosystem has no such calibration. It attacks based on profit opportunity, not on actual harm to the market. A healthy company with a temporarily depressed stock can be just as attractive a target as a genuinely troubled one. And once attacked, a company's ability to recover depends less on its actual health than on its ability to withstand a coordinated financial assault. There is also the question of who benefits from this system. The profits flow primarily to hedge fund managers, a small group of extraordinarily wealthy individuals who have structured their compensation to capture most of the upside while sharing relatively little with the investors whose capital they manage. The costs are distributed across employees who lose jobs, pension funds that absorb losses, retail investors who sell in panic, and the broader economy that loses productive capacity when viable businesses are destroyed. The short-selling industry is evolving. Technology has made research faster, cheaper, and more sophisticated. Machine learning systems can now analyze satellite imagery at scale, track supply chains through shipping data, and identify patterns in corporate filings that would have taken human analysts years to detect. Social media has created new channels for distributing short reports, reaching audiences that traditional financial media could never access. Cryptocurrency markets have opened entirely new frontiers where the rules of traditional short selling do not apply, and where manipulation is far harder for regulators to police. At the same time, there is pushback. The GameStop episode revealed to retail investors how short selling works and showed them that coordinated action from the other direction was possible. Regulators in several countries have tightened rules on disclosure of short positions, required more transparency in the lending market, and cracked down on some of the most egregious naked short selling practices. Corporate executives have become more sophisticated about defending against short attacks, building legal and communications teams specifically designed to respond to activist reports. Some companies have even begun publishing preemptive rebuttals of potential short theses, trying to inoculate their shareholders against future attacks. But the fundamental economics remain unchanged. Betting against companies is profitable. It will continue to be practiced. The players at the top of the industry will continue to make fortunes. And the companies that are targeted will continue to face difficult choices about how to respond. Whether this system produces net benefit for society or net harm is a question economists will debate for decades, probably without reaching consensus. The honest answer is probably that the system does both, exposing real frauds while also damaging real businesses, disciplining weak companies while also destroying viable ones. The final piece of this puzzle, and the one most ordinary investors never fully understand, is that the financial markets you participate in through your retirement account, your investment portfolio, and your pension fund are shaped every single day by this hidden industry. The prices of the stocks you own, the health of the companies you work for, the wealth you're able to accumulate for retirement, all of it is influenced by bets being placed by people you will never meet, against companies whose names you may never know, in offices you will never see. The business of betting on failure is one of the largest and least visible forces in modern capitalism. Understanding how it operates is the first step toward understanding what your money is really doing when you send it into the markets. If you want to keep pulling back the curtain on how money actually moves, our next investigation examines how the largest banks in the world quietly orchestrated the collapse of entire national economies through a single financial instrument. And it is waiting for you on the screen right now. Watch it next, and we will see you in the next one.